Merry Business FM, it's the morning drive. So we're talking legal matters and restructuring and all of the above. Headline GDP remains resilient. We know that. Under the surface, there are pressures, of course, as there always are, but lots of companies feeling the mechanical pressure of rising debt costs. Tighter global liquidity is putting pressure on GCC companies. Here to discuss how the UAE, and I guess the wider Gulf as well, is navigating a changing M&A and restructuring landscape and whether distressed asset opportunities are maybe growing across the region is Seema Osaran. She's a corporate lawyer with BSA Law. It's good to meet you. Good to have you here.
Lovely to meet you.
Good to have you in the studio. Do you know, I wanted to preface this whole conversation. It's a really tough thing to discuss because
100%.
this has a real impact on people. It's a tough position to be in, to have to face money getting tight. But there is a need to face the reality of that. We all have to do it. Of course we do. First of all, Seema, how much pressure are GCC companies facing as we see liquidity tightening and from higher interest rates, just broadly speaking?
Honestly, I think that there's been a lot of stress and discussion around this liquidity crisis that's appearing around us here in the UAE and the GCC, but it doesn't exist. And we need to be very careful on how we characterize the liquidity issues that we're facing right now because it's not a crisis.
Okay.
We are still very liquid. At a government level, we are still very liquid. You have to understand that the UAE is a receiving market. So we're on the receiving end of goods and services and ideas. And we're essentially in a place where we're at the intersection where we receive assets from all over the world, investments from all over the world. We haven't seen yet that our liquidity has been massively impacted. We're still seeing people are still very able and willing to invest in the country. We're still seeing capital in the country. People still want a prime piece of the market. The thing that has changed is the mood. We have an appetite for investment, but it's about what we want to eat. Right now, people are being a bit more selective. They're a bit more concerned, a bit more cautious, given the discussions around the region. And we'll see people being a bit more tentative on how fast and how much they're willing to invest, but not a complete stop in investments altogether.
It was interesting. Actually, the message is relatively positive. We've been talking for a long time about how it's a wait and see attitude, how people are sitting on their hands. That's a phrase that we've heard lots of times. And this is not, certainly as far as I can see from the discussions that we have in this studio, this is not a COVID situation.
No, absolutely not.
The perception may be, it's this, it's that, but it's not COVID, is it?
No, absolutely not. And it's the same for interest rates, really. We broadly follow the Fed. So we are pegged to the dollar. We broadly follow the Fed. And insofar that we're not seeing some massive instability on that front, we're not going to expect COVID interest rates. We're not going to expect those hikes in interest right now. At the end of the day, what we have to understand is the money is there. People are just more careful. And that's a very positive message going forward because we have the framework to support it here, realistically. We've seen that the government is willing to step in. We have to remember we don't live in a country where the government sits back and watches the system seize up. We live in a country where the government takes proactive measures in order to ensure that everyone is protected. The key sectors are still vitalized, that we have support for banks and borrowers. We saw that during COVID, and we're seeing it similarly here. Even in minute aspects like tax residency, the government has stepped in. It's taken measures to extend periods for people to obtain their tax residency status and visa status. People who were stranded abroad at the beginning of the conflict, they've now been able to come back to Dubai to renew their visas. These are just small, minute things that the government is doing on a day-to-day basis, but we see the same support on an economic level.
These were immediate measures taken, and I think very often what we miss is the immediacy of those measures the point of that is it gives you time.
100%.
And it gives breathing space. And that's kind of the first thing you need. When you don't know what's going to happen, when you have as much uncertainty as we faced.
100%.
I mean, that's important to remember, I think. I know I'm not going to ask you for specific details on transactions or mergers or acquisitions. I know you can't do it. So I wanted to talk to you this morning, and I think there's a need to talk quite broadly. But which sectors, and if you can look at this broadly, whether it's retail or traditional logistics, whatever, which areas are seeing restructuring activity, and which are the areas where refinancing is maybe more of a challenge at the moment?
Obviously we have to look at things like family groups. They're the backbone of, family conglomerates are the backbone of the GCC economy, okay? And any businesses which were struggling pre-war, or however you want to classify the situation, because I wouldn't classify it as a war personally.
Let's pre-conflict.
Pre-conflict.
Yes.
Any industries that were struggling pre-conflict will be struggling more now, not because of the conflict, but just because it's exacerbated underlying issues.
Okay.
You have, for example, family conglomerates that were undergoing restructuring pre-conflict. So let's say the Saudi bin Laden group. You have Majd Al Futtaim, very, very promising restructuring proposals, which have really revitalized their sectors. I think we can't take it as a sector-by-sector approach, because it's more generally any business that was struggling pre-conflict is still struggling today and will still be facing restructuring. I think we see a lot of kind of activity around the real estate region, just because now we have developers who are a bit stretched, given the fact that they're facing issues obtaining their materials for construction. And we know Dubai is a place where buildings are propping up every day, and you're seeing new developments every day. So developers are a bit stretched. So as a result, you'll see real estate being a bit further stretched. But otherwise, I don't see that there's a key sector which is facing impact. We're seeing hospitality being impacted.
I was going to say
in the
tourism
UAE.
hospitality.
Yes,
obviously.
absolutely.
Yeah.
But it's not necessarily to the point yet where we're seeing major restructuring in that field. We're seeing what you would expect to see across the board. And I don't think that that's necessarily a good thing or a bad thing. 100%. I mean, there are absolutely distressed opportunities right now. Real estate is absolutely a distressed opportunity, but we're not in a distressed market. So I think there's a key classification.
But that's the difference, isn't
Yes.
it? And that's
Yes.
really important to get across, I think, because this is, look, distressed equals opportunity.
Yes, absolutely.
In modern parlance, I suppose. And that's the difference between a market that is distressed and people that look at a market
Yes.
as being distressed.
I mean, you have to look at the UAE as at the intersection between capital and commercial leverage at the end of the day. You're looking at a country that has no shortage of capital yet, and I don't think it will have one in the near future. Okay. And you have the commercial leverage because it is known as a hub. You're talking about one of the top, DIFC is one of the top 5 locations for hedge fund managers. You're looking at an industry which is very, very well supported. And so I think you can't classify our market as it stands as a distressed market. But distressed opportunities exist irrespective of how distressed the market is, because people will want to buy when they can buy at a better price. This is always going to be the case. And so you will look at businesses looking to merge with other corporations. You will look at businesses which are looking to refinance. You will look at businesses which are hoping to convert their debt into equity. This is definitely going to happen now, but those are the same businesses that would have done that pre-conflict. This is the key thing. And this is just more of an opportunity to revitalize. And I think that's the general idea that you get with the UAE framework as it stands. We have a specialized restructuring framework. Like at a legal level, we have a framework which is specialized for restructuring that was introduced in 2024. And the larger sentiment around the UAE isn't that, the business is dead and so let's scrap it. The sentiment is the business can be revitalized.
Let's see what we can do.
Let's see what we can do.
Well, that's kind of this sounds corny and it sounds like the party line, but that's kind of a prevailing attitude. That's very much an
100%.
attitude you see. I think maybe we could do something more than we're doing.
Yes.
That's kind of a way of looking at things. It's a less what's the word? It's less mercenary way of looking at things. Something that I think is really important. I wanted to talk to you about the importance of communication and the importance of early intervention. But I want to talk to you first about realism, because we often talk about founders need to be realistic. You know, when you have the idea and you've got the business, you may have an investor and you're like, I'm going to change the world. It's going to be be realistic. So for maybe a founder who might be watching, maybe listening at the moment, they know that their balance sheet is, maybe you're treading water, you know, you're trying to get up the side of the dock, if you like. What's the first step to take? What should you be thinking as a founder in a position like that?
I mean, you can take real examples of what's going on in the market right now. I'm not sure if you've heard about what's happened with IFCO.
I haven't, no.
So you're talking about one of the largest food and fast-moving consumer goods manufacturers. It's a Dubai-based entity, and they had a debt balance of 2 billion, and they've undergone a massive restructuring right now. They've looked at their balance sheets, they've assessed, it's been led by HSBC and other creditors now. They're undergoing a massive restructuring. But you're looking at this sector and you're saying, well, from a realistic perspective, this is one of the most vital sectors that we have. It's food and fast-moving consumer goods, you know? They own Londonderry, for example, here in Dubai.
Okay.
Yeah, so you're looking at something that's massively vital, and they're still having to undergo restructuring. And so there's no correct way forward, realistically.
Right.
What you see here is, for example, NMC, which is hospital chain, during COVID.
New medical center.
Exactly, exactly.
Yeah.
During COVID, they also underwent restructuring. But what we're seeing in both of these cases is the government will step in to protect vital sectors, right? And so you see here, food, fast-moving consumer goods, this is vital to our economy. And so now we're expecting to see the government will step in the same way that they did with NMC, and they stressed the importance of keeping the hospitals running while COVID was in its outbreak. So you don't really know what the starting point here is when it comes to restructuring. Always the best opportunity, I would say, is to capitalize on transforming debt into equity. But there's no hard and fast rule, because it very much is a case-by-case basis based on the business model of the company, based on the jurisdiction. It's never as straightforward as one approach, but you can see that it will happen on any level, whether it's the smallest of companies or the largest of companies. Restructuring is not necessarily a bad thing. It's just an opportunity to rejuvenate.
Okay. Let's talk communication, because I mean, I guess you spend a lot of your time sitting talking, listening to woes, and that's part of the day-to-day, isn't
100%.
it? Early intervention is really important, but communication leading up to that is key, because there's a great benefit from working towards, I don't know, if you're in a situation, a consensual workout with a bank, for example, rather than leaving things hanging and heading perhaps in a legal direction in your business. I mean, the point is to communicate, to talk about it, isn't it?
Agreed. And this is what the new legal framework actually puts in place.
Right.
Our new legal framework right now actually encourages settlement between parties.
And allows for mediation.
Yes, allows for mediation,
Right,
allows for
right.
negotiations. Rather than taking it straight to the courts and rather than taking it straight to court involvement, what you have is these preemptive steps. Because again, like I've said and like I've stressed throughout this entire conversation, the UAE is really taking this approach when it comes to restructuring as this is not the end. This is a new beginning. And so it is encouraging these kind of minute steps to take on the way. And they're in place at law. So they're our baseline. We move forward. We have appointed mediators who handle these situations. And I think that it's important to put focus on that rather than stating that, we're going to go straight to liquidation. We're going to have a court-appointed liquidator. They're going to liquidate all of your assets and they're going to distribute them to all the creditors. This is not what we're seeing right now. We're seeing people really going through kind of these operational, organizational discussions where they're discussing how they can rebuild, readjust, and renegotiate.
So that's communication, that's early intervention, but there's also a need for, I mean, from what you're saying, I get the feeling that transparency is or should be a key policy because particularly when it comes to talking to somebody like you, for example, because you need to know what's going on.
100%.
So that if you're able to be open with a legal team, just as an example, transparency is generally a great policy, I guess, for most people. But if you're open with a legal team, that mitigates personal liability potentially, doesn't it?
I mean, you're looking at it more from the perspective if you're open with the lender than with the legal team. Because
in this instance, yeah, you're right.
If you're looking at it from the perspective of being open with the lender, let's say, for example, the lender is going to run these really, really intensive due diligence checks on you that weren't necessarily a requirement in previous loans and transactions that we had pre-2020, I would say.
Right.
Now we're seeing that the lenders are being a bit more diligent in how they go about knowing their customers. And this is really important. And because of that, we're seeing that, like you said, the liability is shifted slightly onto the lender. The lender is now responsible to do their diligence, to ensure that they know their customer before they're giving out massive sums of money. This is really important.
And it's buyer beware, isn't it?
Yes,
Yeah.
exactly. Caveat emptor, buyer beware.
Yeah.
You have to know who you're dealing with. And I think that the framework that we have at law here really does put stress on that, which is very important. And I think this whole concept of more due diligence, we're going to see more of it now post-conflict because foreign investors are going to be more aware of, the stigma around the region. And so they're going to have a bit more of a cautionary approach when it comes to throwing all of their assets in. And we're going to see this now with mergers and acquisitions as well. It's not that people will stop wanting to participate. Everyone right now has their knives out, but they're just waiting to make the first cut. But
we're in that mercenary world again.
Exactly. We're in the mercenary world again. But, you're waiting to make the first cut. You don't want to cut too close to the vein. So they're just being a little bit more cautious. They're being a little bit more preemptive. We're seeing this reflected with banks. We're seeing this reflected with companies that are hoping to merge. We're seeing this across the board. This is a very positive thing. It's not a negative thing. Yes, 100%. We can characterize it as negative. We can say, people used to be so willing and ready to invest in the region without a second thought. That second thought is necessary because it's going to protect the vitality of the region.
I think that's a fair point to make. That's another level of safety, another level of security, I suppose. In your chosen field, the law, what we've seen in the last 5 or 6 years, particularly since COVID, I think, is the legal landscape has moved. Incredibly fast isn't close. It's kind of lightning speed.
100%.
It really is. It's amazing. And I wanted to bring up Federal Decree Law Number 2020, Law Number 20 of 2025. Let me get this right. Fully in effect this year. It's the mechanics of merging or even moving companies has changed, right? So, and I wanted to ask you, how has that made it easier? Has it made it easier to restructure a business that may be struggling? That's, as far as I can see, that's another stage that we've seen very recently.
No, 100%.
Am I reading that?
No, you're reading that absolutely correct.
Right.
And again, it goes back and it speaks to the way that the government wants to get involved to keep businesses afloat. They don't want businesses to die. And so now we're discussing restructuring on a different level. We're not discussing restructuring from the frame of, okay, this company has gone insolvent. We have very limited options. So we're going to restructure the debt in order to repay creditors and slowly wind up the company.
Okay.
We're looking at it now from the perspective of we're going to restructure the company to try to keep it afloat because we can have better outcomes. And the whole importance and stress is on better outcomes. So
So this is another level, but it's also another. It's a kind of a switch in attitude
100%.
as well. It's a different way of looking at
100%.
restructuring.
But it's not even just the attitude. It just speaks to the fact that our legal framework is advancing, like you said, at lightning speed, and advancing for the better to consider all options, to consider everything that's going on in the region. This is a very, very positive thing because it tells you how adept our legislators are at actually preempting what's happening in the world. Because it's very relevant that this framework has come into place at this time.
Well, it is. It's also. I don't quite know how lawyers keep up because there has been so much.
We don't even keep up, to be honest.
No,
I
I'm just going to say. Well, thanks for the honesty. I appreciate that. Look, final question because we're out of time, and it's more of an observation, really. So, the way I suppose the modern way to look at restructuring is that strategic restructuring isn't a sign of failure, particularly when liquidity is you're in a tighter environment from a liquidity perspective. It's more a sign of, in some ways, it's more a sign of proactive, more sophisticated management, isn't it?
Absolutely. And that's what the crux of it is.
Okay.
That's what the crux of it is. Of course, there are times where it can be from the perspective of, really having the business have its final goodbye. But in most cases, and specifically with the attitude of the UAE, it's a new hello.
That's a good place to finish, I think. Seema Ossaran is a corporate and restructuring lawyer, corporate lawyer at BSA Law. It's been good to have you here. Good
It's been great
to
to speak to you. Thank you so
very
much. Thanks.
If you're a podcast listener, search for Mira Business FM on Apple Podcasts or Spotify or wherever you get your podcasts from and give us a follow. This is Mira Business FM.